Happy Thanksgiving to everyone, and also a happy Black Friday. We have a bunch of sales currently in the stock market with many great companies, of which 5 we'll be discussing here today. And then at the end of the video, I have a big announcement about the future of the channel. But without further ado, let's get stuck into the first company, which is Meta. Most people understand Meta's business. They are the social media empire. If we added up the monthly active user base, the number of users would equal the entire world's population. Now that's not quite accurate because there is extreme cross-pollination of these apps. Most people that use one of them tend to use 2 or even all 3. But the story is only getting more exciting about the next couple years for the baseline business of Meta, because only 2 out of the 3 of those apps are actually monetized. In the next couple years, we will see a full rollout of ads on WhatsApp in their status area, and also paid premium ads directly from companies. They are also starting paid subscriptions. For example, if I offered a premium messaging service, which I don't, we could have a channel on WhatsApp and you could pay $10 a month and I would send you messages and updates directly. This is such a big boost for Meta, a huge amount of money, 30 to 50% increase in revenue and profit in the next couple years, all coming down to the success of this WhatsApp rollout. However, that is not the only big change coming to Meta over the next couple years. We also have Meta's AI. They have pumped in a huge amount of money, probably around $100 billion already, but we have not seen Meta even attempt monetization. This is a classic strategy of Zuckerberg. He loves to give you a product for a few years, introduce ads slowly, and then very heavily monetize it around years 5 to 7. So this layering of different S-curve growths, we started with Facebook back in 2015. Instagram became heavily monetized in 2020, 2021, still growing. And now finally we're getting WhatsApp, and then eventually we'll also monetize AI. However, the cons of Meta really comes down to one giant cost that is going to grow exponentially, especially in the next 5 years. And it all comes down to the heavily publicized depreciation schedule of these data centers that are powering online AI. Meta is expected to have around $70 billion of capex in 2025, maybe growing as much to $90 or $100 billion next year. A lot of that spend is going towards data centers or other physical assets that will depreciate and go lower in quality, need to be replaced over time. And they're assuming roughly a 6-year depreciation schedule. So everyone is doing their own little back of the napkin mathematics here, trying to see how fast is Meta growing revenue, around 26% year over year. So that means next year we're getting around $22 billion of extra profit. The year after, maybe around $30 billion of net profit before we take on these other changes. So if we consider Meta's current trailing 12-month profit of around $60 billion, if we do have that heavy depreciation start to kick in, profit growth could reduce back towards 15%. Based on those assumptions that I'm making, Meta is going to slightly outperform expectations, growing around that 15-20% with a forward P ratio of around 18. For that growth, they should be valued somewhere around the mid-20s. That gives Meta in the next 12 months around a 40% upside based on those assumptions. And in terms of a very short-term target around this really bullish time of the year, we could expect to go back to all-time highs, 22% growth from the current price of around $650 a share. If Meta wasn't up to your standards, I have a couple more dividend type companies, slightly safer, coming up next, and we are going to start with Southern Company. Southern Company is a utility based out of really the Midwest and also Southern America. Now, the exact services of Southern Company include natural gas distribution, so getting gas to your house as a resident, to businesses and to industry. That could be pretty lucrative with all the data centers getting built around the place. But we also have the traditional electricity generation. That energy comes from mainly gas, but also renewables and nuclear. In terms of their oil and coal-fired plants, they are slowly slowly getting decommissioned by 2035. Utilities tend to grow by investing in physical assets and then charging a few extra percent in terms of your electricity bills every single year, expecting to grow profits and revenue around 8% per year CAGR to 2029. And if we have a look at the price chart, Southern has gone through a recent sell-off where the company's stock price would have to increase around 10% to get back to all-time highs, where at the current valuation of a forward P ratio of 20, we're starting to get to the more middle to upper end of the valuation. The dividend yield is only around 3.3%, but the next dividend company, and the last one, is more in terms of the REIT space. Iron Mountain is a 4% dividend yielding company, but it deals with REITs to do with storing and managing sensitive data centers, and backing up your IT data. So what they do for 95% of Fortune 1000 companies all over the world is they store your data. They can also sensitively decommission it, get rid of it, delete it to make sure it doesn't land in the wrong hands. And this business is likely only going to grow in terms of that nature. There's only more data to store in the long term, but they're also breaking in terms of renting out data centers. Currently operate 452 megawatts of operating data center capacity, 203 megawatts are currently under construction, and that could all double in the next few years. In terms of this translating to revenue growth, the company is accelerating revenue growth from 11% average per year to 12%. That new exciting field growing 20% is going to go from 28% of the total revenue up to 40%. Now, this has a very powerful effect on, yes, the revenue, but also the valuation of the business. So when we have a look at the price chart here, we've had a recent sell-off. We could get a 25% return to get back to the prices we only just saw in early November. And all of this is for a decent valuation, somewhere around a 21 forward P ratio, again for an accelerating growth company. In terms of the cons of Iron Mountain, I guess they're tied up with this data center boom that's going on at the moment. So if everyone is building out data centers, then maybe they could charge less over time for renting them out to customers, and that 13% revenue growth moving forward could maybe be something more like 10%. Company number 4 is a bit of an old name on the channel. We've talked about it for a while, which is PayPal. And under the new leadership of Alex Chris, leaning very heavily towards buy now, pay later, and also AI. Starting with the buy now, pay later space, they take some commission, they sell you the buy now, pay later, and they sell that asset onto other companies. Here they have a list of Blue Owl Capital. They take on all the risk, and PayPal just makes that beautiful high margin, but also low risk transaction volume. This revenue is growing above 20% per year. And really, PayPal is doubling down on just stealing market share. They have this buy now, pay later space that's growing heavily, but they're also offering so much cash back to people when you buy things through PayPal. That's likely why their operating margins are so low at about 18%, whereas MasterCard and Visa, they're up at around 60%. PayPal is just trying to steal that market share, and then in the long run, as they mature, they will start to increase operating margins. I would not be surprised in a decade if they're at 60%, but for now, that's a long time away, and I'm not pricing that in. In terms of the AI space, PayPal is making a deal with OpenAI to do all of their transactions through ChatGPT. Now, I believe this is an exclusive deal and one that could almost double PayPal's revenue in the next couple years. Nobody really knows just how lucrative this could be, but OpenAI has 850 million active users every single month. And even if 10% of those people do a transaction, to buy shoes or buy clothes, PayPal could take 0.5% of that transaction volume, hundreds of billions of dollars of potential revenue, and that's extremely high margin. OpenAI is actually motivated to make this deal attractive to PayPal because they had no way of doing transactions in their own platform. So therefore, I think this is one of the most exciting plays at the moment, especially if we consider that PayPal, having a look at their stock price, it's only sitting here at 62, which corresponds to a forward P ratio somewhere around a 10. To go back to early 2025 prices would increase 44%. And even then, that's only taking the company back to a forward P ratio of just 15. But if you also add in the 9% share buyback program per year, that could transform this company's EPS growth to over 20%, growing margin in the future. That could attract valuations in the 20s, 30s, 40s for this type of company. So PayPal, by the end of the decade, could ×5 or ×6 in stock price. And really the only risk is OpenAI. They do talk a lot of shit, kind of like that one friend you had in high school or college, and also doesn't often back it up. They have deals that might happen or may not in the future. And also you just have general recession risk. And that leaves us to the final name here, which is MicroStrategy. Now, MicroStrategy, think of it as a company that takes leverage bets on Bitcoin. They also have revolutionized the way that corporations sell their debt to the market, backing up for every $100 of debt with 10% of a share of MicroStrategy. All of this has never really been done before, and it is extremely exciting, especially for financial nerds. However, the company is extremely risky, a very heavily leveraged bet on Bitcoin. I have a 10-minute video diving deep into MicroStrategy. If that tickles your fancy, click on the card on the screen. We have arrived at the special announcement at the end of the video. You're either asleep or you're a really big fan of the video. So either way, I appreciate you guys. So first up is I have a few months off from my main job. I'm going to focus on growing this YouTube channel to profitization, where we're above 1,000 subscribers, growing strong into the new year. Now, the branding I want for the channel is authenticity, transparency, and also success. Those are the three things that we're looking for. Authenticity is the major amount of revenue and profit from this channel is not going to come from brand deals. It's going to come from profits on investing and also people following the channel. A lot of big financial YouTubers out there make almost all of their money through brand deals and almost selling out their viewership. And the best advice many of these people give is to buy the S&P 500, which in the next decade is likely to return you exactly 0%. The next is transparency. And of course, we've already seen this with the model portfolio, where you can see the ideas of this channel play out. And I measure the success of those returns over time based on just the average person putting around $300 per week into their portfolio. And that leads into that final branding aspect, which is success. And part of that is up to you guys. If you want to help the channel steal market share from people who really are just monetizing your attention without giving back to you, the audience, then make sure you subscribe. I hope to see you guys in the next couple months. Things are getting really exciting. See you next time. Bye.